Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Krista Morgan, the general partner and CEO of Stage Fund, which is an early stage private equity fund that invests and acquires companies out that are got stuck inside a venture capital investor's portfolio. If you're not growing fast enough and you raise too much funding, you get stuck and sit there until somebody like Krista comes in to help you restructure the cap table and the capital structure, refocus these business that could be healthy again, and bring those founders over to successfully help them grow their business again in a turnaround kind of situation. So it's an expert episode. Krista is talking about what she's seeing with these kind of companies inside VC portfolios, what's happening in the M&A market. There's a lot of practical advice for how founders can be thinking about growing their practical software businesses and eventually talking to M&A investors. It's a great episode with Krista. And we're live with Krista Morgan, the general partner and CEO of Stage Fund in Vancouver. Welcome to the Practical Founders Podcast.
Thank you. Thank you. Thank you for having me.
Well, we've met before, and we had one of those conversations after at a tech event, after a dinner, where we introduced ourselves, and then an hour and a half later, we deep dived into what's happening in both of our worlds, and we realized that even though you're an investor, you have a lot of the same beliefs and perspectives as from the practical founder side of things. So they're not always misaligned, but you're a very interesting type of investor, Krista. Tell us about what you're working on at Stage Fund. What is Stage Fund and what do you do there?
So we are an early stage private equity fund, and we are doing control acquisitions of typically Series A companies that have been on the venture path that for whatever reason are not going to continue down the venture path, and they need an alternative option. And so we are an alternative to venture. And as we were talking about before, I think I'm really a practical founder at heart, and we're trying to take these VC backed founders and say to them, hey, plan A, right? Plan A of build rocket ship and go to IPO and make $1 billion. That plan is not going to work out. So is there another plan that actually can still save all the hard work that you put into it and give you an alternative path that actually can have a good outcome for you and hopefully for me as well.
Yeah.
Along the way.
So you have you're on your second fund, as I understand. So you have investors, and
Yep.
as general partner finds investments and talks to companies to invest in and literally buy out, I guess you would say, kind of in your world, and then does the deal. And your job is to pay back your investors way better than what they would invest in other things, real estate or the stock market or something like that. Is that, just to be clear, you're
Of
doing these
course.
kind of, yeah, but you're not a seed investor VC or a big VC or even a big private equity. It's kind of this unique situation. I've never heard of anybody who's approaching it in the same way as an investor. And in some parts of this big software ecosystem, we talk about distressed software companies that tried and failed and are stuck. And a lot of VC, maybe half the VC funded software companies don't make it to, the next stage or aren't successful. So they got to find a home, but you're finding a very specific kind of home for a very specific kind of company. It's not a huge fund, but tell us specifically what the model is. And then we'll talk about all the practical founder topics that would be useful to hear your perspective from your lens.
Yeah. So probably easiest to let's talk about actual company because I think that makes
Yeah,
it
yeah, yeah.
easier to understand. So we really one of the first companies that we bought that is now doing very well. So this company was in retail technology. They had raised, I want to say, about 13 million of funding and probably had $5 million of debt. And they came to us because it was 2020, the end of 2020, and they were in retail tech. And turns out with COVID, retail tech was not a great year for retail
Yeah.
tech. So their revenue declined. Their investors were out of funds, so they weren't willing to keep funding. And their lender was sitting with $5 million of debt saying, how am I going to get this recovered? And so we got introduced to them. And in the end, so the way the transaction worked is like we did an asset purchase. So we like took all their assets, we
Okay.
put it into a new company, we restructured the debt. We gave the original founder still has some equity on the cap table. We re-upped the management pool. And now we have this, new company. And in the process of that shift, so in that transaction, we'd have a lot of conversations with the now CEO, who was the COO at the time, and say like, look, like, you have too many people. He's like, I have amazing people. I'm like, you do. You just have too many amazing people. So you need to pick the most amazing ones and keep them. And then let's keep going. And I'll tell you, like that company, the year we bought them did, I don't know, something call it 5 million of revenue, lost $3 million. And the first year that we owned them, they did 8 million of revenue and made $1 million.
Hmm.
And now, when I sit and work with the CEO, he's so proud. Like his gross margin is up, his EBITDA is up. Like he's really like, I can't believe what I can do with so much less than what I thought.
Isn't that interesting?
Mhm.
And so this is, I talk about keeping practical founders for most situations. They shouldn't be taking big funding drugs. You don't need it. They don't have a big market. They're not going to end up as $1 billion payback, so they can't raise $50 million and play all that game. So I'm keeping them
Uh,
off the big funding drugs. But in some sense, you're part of the recovery system, and a lot of VC funded companies fail outright. And I don't know what happens if they don't find somebody like you to help them recover. But you're kind of like detox rehabilitation for, they're, and I've been there, they're addicted to spending, fast growth, and go, go, go. But when the fast growth doesn't happen and the new funding doesn't come, it's very difficult to get unfunded and go back to profitable. And it's a DNA change and a culture change. Is that what you saw at this one company? They actually went, "Oh, I didn't know you could spell EBITDA," and all the rest of that.
yeah, look, I think what they didn't have before was that they did not have an investor that said, look, it's okay if we don't grow at all costs. It's okay if we actually have more
Ah,
moderate growth and, we're
right.
doing this and we're willing to take risk with you. Right? Because we're a control owner, which really means I would say like from an operating standpoint to be in our portfolio, it's almost a little bit like being in a holding company. It's almost like you get
Yeah,
bought by, I don't know, Constellation, right? One of these big holding
yeah,
companies, and you're in this network and we're doing this together, right? I'm not
yeah.
like, hey, CEO, you don't get a lot of money, you don't like, we're not going to give you that much investment. We're going to hold you to really tight targets. This is going to be really hard. And like, good luck. Call me every quarter and tell me how it goes. Like that's just not how it is, right? We're
Mhm.
right there with you and building as I think every one of your founders knows, if you are building a company with not a lot of capital, you have to, in some ways it's riskier because you have to take bets. You can't do everything. You have to like
Right.
look at all your options and go, you know what? My gut is telling me we should invest in this one growth initiative and that I'm going to see if that works. And sometimes it does and sometimes it doesn't.
Right.
And what we say to the CEOs in our portfolio is it's okay if it doesn't. Like we'd rather you just took a bet and really tried one growth strategy versus trying 17 things. And if it doesn't work, it doesn't work. And then we
Yeah.
do something else.
So you're kind of picking over that massive mound of stuck VC funded companies that raised 10 or $20 million and then piled silly venture debt on top of it. And venture debt is not just like SaaS debt. It's
Yeah.
it's debt based on we're going to get paid back when you raise the next round. But
Correct. Yeah.
almost nobody raises, fewer than half of Series A get to Series B, you get to, and
Yeah.
then half get to Series C and so forth. So, and then debt is different than equity. Equity is like, well, sorry, didn't work out for everybody, but debt is like, we own you now, and we expected this to work out, and we're coming for it, kind of thing. So, very
Yeah.
different game. Would you say that you're turning these VC funded bets, which they probably some made with full understanding of what they were doing, and others were naive about what game they were playing and found themselves stuck. But are you turning them from VC funded grow or die businesses into, let's say, practical SaaS businesses that are profitable and have reasonable expectations and can grow, and you can add to them with a little debt and a little acquisitions and that kind of normal recovery game? Is that what you're doing?
I would say yes. I would say that's exactly right. And you
Okay.
made a comment earlier that I think is important, which is that's actually really hard to do. If you're the CEO
Yes.
sitting in this company and you took
Right.
Series A financing and you're now like, how do I get this restructured? It is incredibly hard to do because there's no clear path for it. And most
Yeah.
people don't really even understand all the nuances of like what it takes to do a restructuring of that kind.
So, and you're not just here. We're going to get to the other side. Go there. You have a platform. You have people in your company that help them with HR and finance, and you have an operating partner that sits with them every day, therapy and guidance and control. Meaning, no, you can't spend that. And a big
Correct.
hire, you're right there with them. So this
Yeah.
more adult supervision comes with this kind of serious game. But you are bringing them back to a different state. So on paper, on a spreadsheet, you could do that change in a day. But a founder who has spent the last 5 years of their life selling everybody on this is going to be a unicorn, and now they have to sell everybody on we're going to grow 20% a year profitably. I don't know. That must be one of your filters is can the founder actually wrap their head around a new vision?
That's definitely part of it. When we first started, we weren't sure if the original founder CEOs, would be able to transition in the model. And
Ah,
I think some of them can and some of them can't. But I will say the best performing companies in the portfolio are the ones where the founder can make that shift. Because
ah.
actually, and I'm sort of call it a reformed founder and
Yeah. Yeah, you're a
reformed
founder.
venture backed, tech founder. And it is really hard to make that shift.
Mhm.
But actually, once you do it, I think as every one of your founders will know, it is kind of freeing to not
Yeah.
be running out of cash all the time.
Yes.
It's actually incredibly freeing. Like as just that to take that stress away and your stress is how do we grow? How do I grow without a lot of money? How
Right.
do I do these other things without a lot of money? How do I take a vacation without a lot of money because I can't hire anyone, to stand in for me? But actually, if you know that you can pay for the basics like that, I think people don't appreciate how much freedom
Yeah.
and that gives you.
Yeah. Right. And maybe they really can realize it after a couple years saying, "Oh my gosh, I was in jail after I raised $20 million and had this debt, and I didn't have many options, and I couldn't maneuver, I couldn't make sensible decisions. There was no sense in that. I helped start a company, and it grew fast and grew to $100 million. Went public in 299 and lived through the dot com, and was acquired in 2001 by a profitable company. So we went through the dot com. You can't spend enough on eyeballs. And I was running a $50 million practical business in there, effectively the CEO of Act at the time, contact management software. You need to get to 15% profitable by the end of next quarter inside a different company.
Yeah.
And I managed to do that and then keep it going. And then we grew the business quite healthfully after that. But it was really, really hard. And I had to make a lot of decisions leading that about are you really on for the new regime? So, like the new vision. So, that was a really interesting time. I guess I can relate to a little bit of that.
Yeah, I think people VCs, they hand you a check and they show up every quarter at a board meeting. But really as a founder, like you're alone. You're alone.
Yeah.
And we, I think we almost have this sense of like we almost put this view forward that that's the thing, right? You're this lonely CEO at the top and no one
Yeah.
understands you and and actually my view is that's not really fun. It's not
Yeah.
actually very fun to do that. And in our
Yeah.
model, yes, it's control. Yes, you don't get to make all your own decisions, but you also have people to talk to. You also are part of now a team and you're I think it's a really big difference to like have your management team and then have the person that is writing the check be on your actual team. That is a different mindset. And you are going to get both, I think, supported and challenged in
Yeah.
ways that will help you grow. I
Right.
think that's really important.
So, and you have an operating background. You're not a finance person who said this is a great thing on spreadsheets. We'll go, financial model the hell out of this thing. You're an operator, and you know that, and these are early stage companies. So founders are important, and operational decisions are important, and finding the leverage inside your business is important. You can't actually walk away from those things. So, do you find that you're strangely operator oriented, maybe in the business oriented more than even larger private equity investors, or is that just a private equity side?
I mean, like to your point, right? I worked in advertising, then I thought I'd start
Yeah.
a tech startup, and then that, has failed somewhat spectacularly, which is how I now find myself running a private equity firm. So I guess I haven't seen, how everyone else does it. But I will tell you, yes, having building an early stage company is very different. Is just very different than taking something that is at, call it like 25, 50 million of revenue and like scaling it up. The skill set
Right.
is very different, which is
Yeah.
why we do like founders. We do because I think founders being able to build something when there isn't really anything there and you have to just kind of figure it out. That is, that's just something some people are able to do it and some people aren't.
Right.
So, but I do, and I'm not a great day to day operator. Turns out I actually
Mhm.
am better suited to,
The
basically
deal
doing
stuff.
deal
Yeah.
stuff. I just call people and I think about deal structures and I negotiate things. And it's, honestly, this is the greatest job I've ever had. But I was having done it before. I can now sit with CEOs and just help, just so I'll give you a good example. One of the new companies we just acquired, new company. I've been working with this CEO, and the company had gone up, 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 and then AI. Honestly, they've been disrupted by generative AI. So like now their business model's down. They're trying to figure it out. It's in the marketing tech space. And he's just like, Krista, I need this VP of growth. I need this. He's really been like, I need this expert. I need this magical unicorn person that is
Magical.
going to
Mhm.
give me this growth. And I'm like, no, no. Do you know how often as a founder, I was like, I'm going to hire this magical VP of sales. I think the VP of growth is the new VP of sales, right?
Yeah.
Like I'm
Uh-huh.
going to hire
There
this
we go.
VP of sales and they're going to do everything for me, right? They're going to solve this big problem. And I'm like, you already have a great team. You already have a great team. You already know the market. We are giving you capital to make some investments, but I don't think bringing in this, a big salary, someone that's going to take 3 months to ramp up, someone that's got to like get in, get up to speed, like that's not your answer. You already have everything you need. You just need to trust it and like make a choice and go. And
Yeah.
those are the conversations that, I am able to have as someone that did hire like 4 VPs of sales that none of them ever worked out. and, and I just lived it. I lived it that a magical person is usually not the answer. If that's where you think the answer is, it's because you don't understand. Either you don't understand the problem or you're just not thinking creatively enough, or you just don't trust yourself. You don't trust your own, yourself to solve it.
Well, that's got to be empowering for a founder to say there's no magic answer. And, the answer is in you, the force, may the force be with you, and you already
Yep.
have it kind of thing. And you get to decide. And we're not going to, since it's not an all or nothing bet that has to get to 100 million in 20 minutes, they have a little space to give it a try and maneuver. And I'd also say that's a practical founder trait. They aren't chasing magic. The hard stuff is always there. They have to find leverage inside the business, before they up their investments with people and the rest here. So you're kind of a deal person. You're seeing all these, or not all of them, but many of these overfunded software companies from 2019, 2021, the boom times that didn't really have product market fit and raised 20 million to grow faster and all of that. You're not investing in, there's thousands, of these companies, literally like 5,000 of these companies. But you're investing in a few of them. Are you waiting for these are real businesses with product market fit, but they're investor that's the problem, is the cap table and their debt and so forth? Or is it a combination of, because you're like recapping, you're recapitalizing these, releasing them of all their misaligned investment and investors?
Yeah, you're asking me like, how
Uh,
do we decide? How do we
yeah, I
decide
mean,
what
like,
we're
or what kind of companies are you, they product market fit that have the wrong investment, or are they other ones that you say, "Oh, I think there's a market there. Let's go see if we can find it."
Yeah, it's a bit of both. So I would say we think about acquisitions in terms of platforms. So
Mhm.
a new platform, much like a private equity. So a new platform is going to have typically as close to 5 million of ARR as we can find,
Okay.
right? So we're really trying to get 5 million of ARR. I would say they have product market fit light,
Ish.
which ish, yeah, they have product market fit ish. And by that, what I mean is either they really had something, it was going really well, but like to the company I just mentioned, some new technology, something has come out that has really disrupted their business model and forcing them
Oh,
to
okay. Right,
rethink.
that happens. Right.
That happens, right? To rethink their product market fit, or they've had a lot of their revenue growth has come from a couple of concentrated clients. So it looks like product market fit on paper, but it's not really. So when you only have a handful of big clients paying for things, like that's not real product market fit, right? That's just
Yeah.
you're fortunate. And so, and not just, and but both, we believe both are something we can build on. And we like the industry, and the situation that we're coming in is one that is conducive to a deal like ours. Because look, our deals are not, no one, I tell everyone, like, every, it's really great to have my number, but you never want to have to call me. That is like kind of the
Right. Nobody on this audience is going to call you.
no, 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 no.
Right.
You should only call me. Yeah, you should only call me because you're looking for a distressed add-on to your company, and you think I
I
might have
see.
deal flow for you. So that's a
Yeah. Okay.
good
All
reason.
right. There you go. Yeah.
Oh, right. So in terms of this acquisition, but the situation is such that the investors are ready to walk away, and there is some, call it, leverage point that is driving a deal. Because actually, VCs are highly incented to do nothing for as long as possible and hope the
Yeah.
founder figures it out.
Yeah. No, hope is a
They're
strategy.
like, hope is a strategy. It really is, right? It's just like, look, we're not giving you more money, but you go keep fundraising, you go keep hustling, you go keep trying to do all this stuff, even though
Good luck, kid. Right.
it is not in the interest of the founder because they're sitting on this preference stack that is terrible for them. Like they've just
So
got all
their
this going
piece of
against them.
the company they created is actually getting smaller,
Exactly.
every year. Yeah.
Exactly. And yet they're doing absolutely everything they can to save the, VC investment, which I can't, we talked about this a little bit. Like, I really think there needs to be more thought behind VC contracts that
Yeah.
actually does, if the founders are going to do that and save the investment kind of at all costs, like they should be rewarded for that, right? Like, why are they, anyway, so separate
Yeah.
soapbox, separate topic.
Well, I mean, just so practical founders can hear this, in
Yeah.
the institutional VC funded space, really Series A, B, C, and all that stuff, and seed and safe notes are gateway drugs to that game. More than 50% of the companies don't make it at all. Like, and they don't pay back the investors, which means the founders walk away with nothing. So the default case is it probably won't work. But the reason it exists because there's a chance, and it's a chance it could really go big. And that whole power law game that it's a blockbuster game over there, but most don't do it. But the whole VC pitch game, the dating game, the contract game, the funding game, the clapping when you get funding, is doesn't really account for the downside that is the normal case. It probably won't work. So what happens when it doesn't work? And there's really, everybody's surprised.
Agreed.
Sure.
It's like prenups, or we were talking about this, right?
Yeah. Mhm.
We go most sort of if I were to get married, again today, there would be a prenup, right? We would have a conversation. We would say, "Hey, here's kind of what we're hoping is going to happen, but if it doesn't, while we're still in a good place and we still believe that there is hope, like let's actually just figure out
What happens?
what happened? What happens if it doesn't?" And I think there is a real fear in this VC early stage VC funding is
Ah,
the only industry that I can think of where there is such a high failure rate and zero consideration for that in the contracts. Zero consideration.
yeah,
Not,
yeah,
hey, at this point, founder, we are actually, once we tell you there should be something that says, look, once we are for sure saying to you, there's no more money, you're not getting anything. Here's a trigger. Here's like a down case trigger that's going to happen. So at least then the founder has some agency over
Yeah.
solving it. Now they just have to call the VC and be like, oh, I'm so sorry. I really want to do this deal. You might only get 10% common in this new equity. Your preference is going to get wiped, all this stuff. Like, you know, why do we have to? And founders have if you have not done that before, you have no, call
Yeah.
it, basis for even understanding what
Yeah.
you're
Yeah.
asking for.
Right. Yeah.
They don't know, right? So I'm like, why are we making this so hard? Why are we making the end so hard when it
Yeah.
is hard enough? It is hard enough to be an early stage founder. And when things are not going well, we're just our tendency in tech is really just sweep it under the rug. In my
Yeah.
company, when because we had this big issue in our portfolio, it was a fintech company, and I remember the day I realized it was all going to be over, and mine was there was sort of a big precipitating event. So it was unlike some people, it's just a very slow decline. Mine was like from one day to the next, I knew we were gonna be done. And I just remember being like, I can't talk to anyone anymore. I can't go to any events anymore. I'm not gonna have any, like, we just, everyone's like, well, it didn't work out. We don't want to hear from you because we
Hmm.
don't want to acknowledge how often it happens. Because then we might not get crazy founders that keep doing it. If they
I
were,
think that's part of it. I think that's part of it
yeah,
is, to actually see, like prescription drug ads here in the United States. It's all the happy smiling people, and then they give us all the side effects, like, your head will explode and you'll probably die, but there's happy
yeah,
smiling people on the screen, and so we kind of ignore that.
I love
It's a
that.
little bit like that. So you get to see that. Do you have any sense of the scale of, because you're seeing the underside or the not so
Yeah.
visible side of the VC funded tech world. Do you have any sense for that? I mean, that you could describe to practical founders
In terms of
there?
the volume
Yeah, or
of
I
it.
don't know. Like if they're saying, "Gee, I still want to raise VC funded capital," what would you advise them? What would you share with them about what you see that they don't see?
Oh, goodness. That is a really hard question.
Okay, we'll come back
No,
to
well,
that. That's okay. Yeah, no.
I think all I mean is it is hard because without VC, I would say this, right? Like I'm sort of down on VCs, but actually without
Yeah,
VC, I probably don't have a job. And I think there are also a lot of there are a lot of really good ideas, and let's call it R&D. Right? There's a lot of just R&D that happens in our economy that's really important for our economy that the
yeah,
VCs are funding. And so,
yeah.
I think if you're a practical founder, what you're asking yourself is what I is really like, if I take this money, right? Like if I take this money, am I really confident in what I can do with it? If I were to do this again, right? So if I were to take an early stage tech company, I would bootstrap it as long as possible. I would get it to a place where I felt like it was sustainable. And then I would
Mhm.
actually probably skip the traditional VC. And there's some really creative growth equity, kind of
Yeah,
hybrid growth equity, private equity funds.
yeah,
But I would always take money off the table,
yeah,
always. If I were
yeah.
to take money, you're doing it because you're going to de-risk yourself,
Hmm.
I think is really important. And then, look, I really would be sitting down with my lawyer being like, what if this doesn't work out and how can I build something and some protection for myself
Mm.
that I am not going to be in a position where I've sort of given up agency and we're in a bad situation and I know I'm the only one that's going to solve it, but I'm not going to
Mhm.
get the benefit of solving it. I think that's what I would be doing. I think there's something wrong with saying, I want to go for the big
Yeah,
plan A.
yeah,
I want to go for the
yeah,
big, but it happens so, it takes off so rarely. And
yeah.
so you really, you know, now I run, so stage, we are an asset management firm, right? So it's a weird business model. Like I've actually been building this as a business in addition to the businesses we run. In our business, like I'm like, I want to be cash flow positive. I don't want to overhire. I don't want, because I'm doing it again, and I'd way rather build it a little bit slower than and have it be super
Right.
sustainable. Yeah.
Yeah. Well, so you're practical founder DNA has been revealed here. Is that because, is that because you're Canadian? You're from Montreal, you're in Vancouver these days. Canadians are not as wild and crazy as silly Americans who make these crazy bets. But were you always that kind of practical and serious, or you were just, you were shooting the moon before and realized,
Ugh,
oh, there's a better way?
yeah, goodness, yeah. I no, I mean, I when I started my fintech company, I was sure we were going to be the next, lending
Um,
club. Like
there we
we were
go.
trying to raise money. I was, over hiring, just constant. All I could see in my mind was how big it could get. And what I
Right.
remember is it wasn't just I saw that it could get big, it's that I was always every decision I made was one where my viewpoint was, well, I should make this decision because we're going to be bigger here. I should
Yes.
make this decision because we're
Consumption.
going to be exactly. And now, look, I have big dreams for Stage. I have big dreams. I want to get
Yeah.
billions of dollars under management. I want to create, I want to take this, let's call it this. We're creating kind of a new asset class,
I get it.
right?
Yes.
Like we're
Mhm.
taking these companies, we're doing things no one's ever done. We're building early stage technology companies in a new way. I want this to be giant. But every decision I make is what can I afford today? Where am I today? Yes, yes, I want to be $1 billion. So like right now we
Mhm.
got, whatever it is, right? Under 30 million under management. We're in two funds. Like we're kind of getting going. So I can't just grow at all costs. I can't just make
Right.
all these big investments. And I think finding a way to make decisions in the reality of today while still holding this big vision of the
Yeah.
future, right? Because I think there's this misnomer that like somehow practical founders don't have a big vision of the future. Of course
Right.
they do. Of course they
Yeah.
do. They're just thinking about it in a different way. They're just getting there in a different way. And that's,
Right.
where I want to be because the day we found out, I remember the day we sort of found out about this issue in our portfolio, which is sort of this catastrophic event. I we found out on Friday, Monday morning. I walked in, I fired half my team, and you know what? As it, the company is still around today. The company's still
Yeah.
actually around today. Many years later, it was
Yeah.
acquired by someone else, but the core of it is still there. And I learned I didn't actually need all those people. Turns out I fired 50% of the people, and things still worked.
Yeah.
And I was like, oh, I see. You can do a lot.
So the converse lesson for practical founders is the dream of if I only had 50% more people, it would all work is probably misguided.
It does. It's just different problems, like we
Yeah.
think, like I always say, we think money, especially as we're building companies, we think money is always the answer.
Right.
And money is usually not the answer. There is
Mm.
usually an answer. Maybe it takes money to get there, but people are like, if I just had five more people, I'd be here.
Mm.
Maybe, or
Yeah.
maybe you wouldn't. And there's no guarantee on that.
Yeah. That's great. Let's talk about what you're seeing that is very relevant to practical founders who are growing valuable software companies without big funding. They're getting to 1 million ARR and the first signs of product market fit and 3 million ARR and they're narrowing in and tightening their
Yeah.
product market fit, scaling their business model, 5 million, 10 million. You're rolling up some of these companies. You're acquiring company. You're a professional acquirer, right? With this special
Mhm.
kind of situation. What can you tell founders about why roll-ups can be productive and practical, meaning small acquisitions that tuck into a bigger company in your portfolio? And then we'll go to what's happening in M&A these days because you're buying these companies, you're growing them. You have a view of what's your payback, and that is some type of M&A event, some kind of
Yeah.
transaction in the future. So that's what practical founders are thinking about in the future. Dot, 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 get it to 5 or 10 million and we'll see where it goes from there. Tell us why roll-ups are interesting in your world.
I love this question because I'm on a roll up soapbox these days as well.
Okay.
Here's what I think. 4 years ago, I'd never purchased a company. 4 years later, we've purchased about 12. We've made 12 acquisitions in under 4 years. And what I have learned doing 12 acquisitions in under 4 years is it is a skill. It's actually a real
Yeah.
skill
Yeah.
to like acquiring a company. There's like a language, there is
Yeah.
let's call it, it's just like a whole world. that
Yeah.
from the outside looks very daunting, right? People say the words M&A and you're like, oh, M&A, I don't, like this seems very,
Black
you know,
box. Yeah.
yeah, black box of like, this is kind of some magical thing. And what I've learned when I bought the first company, I was just like, well, how about if you need this, I need this. Let's like doing like the core of M&A is actually just getting to a deal that works for both
Yeah.
sides. That's kind of it. I don't say it's
A
the hardest
win-win.
part, but like that's a big piece of it. And that is just two business people sitting down, having to put their egos aside and saying, what do we both want out of this? How do we get somewhere? And then you bring the lawyers in. You're like, okay, now let's
Yeah.
like turn this business agreement into
Yeah.
like legal paperwork. And and so I think what I would say to practical founders is if you it looks like a black box, but actually it is a very interesting way to grow. Right?
Yeah.
Especially because if you have a profitable company, you have a big vision and you have, let's say, a good team and good traction, that there are a lot of, especially right now, there
Yeah.
are so many of your competitors, I promise, that are
Oh, stop.
just stuck. And you could call them and be like, look, you're doing this, we're doing this. Like, what if we just did this together? What if you come and you take, I don't know, I'll give you 20% of the equity? Like, deals do not need to be all cash, turns out.
Yeah.
Deals
Yeah.
do not like need to be super complicated and they don't, there's just people right now are considering other options. And the biggest barrier is just putting it out there. The number of emails that I just send out that I'm like, hey, so I don't know if this is interesting to you, but we just bought a company in your space. I'm really curious what you guys are doing. I would love to have a conversation and see. And sometimes they're like, oh, Krista, we would never do a deal with you. You're never going to pay us enough. And that happens.
Yeah.
And then
Yeah.
sometimes they're like, oh yeah, we should totally talk. So we bought a company 60 days ago. We are about to close on their competitor. We're going to double their revenue for an incremental $1 million of investment in 90 days because we
Right.
just talked to them and so there's just so much you could do. And what we've seen is that building, I know you're talking about these like Frankenstein companies, and it is a bit of
Yeah.
that, right? You bring a new
Yeah.
team in, but as long as there's enough alignment, there is such a thing as like a G&A synergy and just let's call
Yeah.
it back office synergy. And so even if what
Yeah.
you're saying is we're going to buy this company and have two product lines, well, we think to ourselves, that's not something you do at 5 million of revenue, but why not?
Yeah.
Why not? Is it
Yeah.
just because it hasn't been done? Just because we've left it to the big private equity firms of the world to say they have some magic roll up, advantage?
Yeah.
Like they don't.
Mhm.
They
They
don't.
don't. They're just
They don't.
asking.
They're just doing it. They
Yeah.
just tell people, here's what we're doing. And now, and that I think, especially, and I have noticed, like to your point about market, I have noticed it throughout our whole portfolio and even the companies that we're looking at, everybody is having trouble getting organic growth traction right now. It just is
Right.
it's a hard market. Sales cycles are longer. Companies are taking longer
Yeah.
to
Yeah.
decide. We have so much uncertainty between, AI and then the election and the economy and all the like Fed rates going down. This environment of uncertainty is making it harder to sell. So why wouldn't you spend your money buying some guaranteed revenue, even if it's
Yeah.
not easy? Organic growth isn't easy. Nothing's
Right.
easy in
Right.
business, but it's
Well, last week on
more
the
of a
podcast, we
certainty.
had Ian Manners, who sold his bootstrapped Vivor,
Yeah.
got it to 3 to 5 million ARR, and sold it to a VC-funded competitor during COVID, when his market in healthcare was tumultuous, and VC-funded competitor. It was a little cash and stock deal, so he has piece of that, and that's kind of like a private equity two bites exit kind of thing, a little partial exit, but it was VC funded, so things are happening there that founders can imagine. And when we say roll up, we're saying you've got a company, you can buy customers from a competitor, like you just said, instead of
Yeah.
spending on sales and marketing, and go buy another 150 customers or 1,000 customers. Or you could fill out your solution instead of R&D for the next 3 years that's not on your roadmap to do the other half of your product plan. You could go buy somebody that does that and combine them. Then, right? It's a bigger bet than, going slowly and doing it yourself.
And it is, but I actually think it's a little bit of a safer bet. Like if I
Ah,
and only safer because you're dealing with something that is a known quantity, whereas investing in like a new VP of growth or investing in,
ah,
an agency, like
mm,
investing in something that is going to grow is very different than buying something that already exists where you can diligence the problems. And what
yes.
you can say is, I'm going to buy this $3 million of revenue,
Mhm,
and yes, it's risky. Here are the risks. Here's the customers that
mhm,
might churn. Here are the problems in the product. Here's the tech debt I'm taking on. Here's I don't know, whatever it
mhm.
is, right? And here's the equity I'm giving up. But normally, if you do it well, like that revenue is probably pretty sticky. And just
Yeah,
getting enough scale, like so much of what we're trying to get to in tech is just enough scale to support the core costs of like the hosting and the engineering and like the G&A like that you need.
all the
So
operating costs, yeah.
if when I'm thinking about and we look at roll-ups in a lot of different ways. The retail tech company I told you about, we did a roll-up with them where they were in retail tech and we bought an e-commerce tech company and we put them together. Has it been a slam dunk? No, but the company's profitable. Like they have been able to cross-sell on customers. They have been able to like have success on it. Like it's not, again, it's not, I'm not saying, again, it's no silver bullet, right? So it's not easy, but it's actually, I think, from a business, let's call it like a business problem standpoint, it's like a really fun problem to work on. Company
Yeah.
integration, product integration, figuring out cross-selling customers, like that's actually pretty fun.
Yeah. Yeah,
And
I've
we
been
don't,
there because I've created
yeah,
companies that have, been acquired by bigger companies, and then we're doing that, all right, how do we all fit together and central sales and marketing, and I can only take that for so long. But it was interesting to hear about it and so forth. But, it's a very interesting puzzle that most of the practical founders I talk to and work with aren't really thinking about, like, that next stage up, right? Puzzle of
yeah,
multi-product line, right? Multi-region, multi-audience, multi-channel, right?
yeah,
It can get a little complicated and maybe a little daunting for founders there. But that's, acquiring companies is a possibility there. So that's kind of a private equity playbook
yeah,
thing. Let's tuck in some acquisitions and get to more scale.
yeah.
Let's talk about some other private equity playbook things. Do you add a little bit of practical debt to give them cash that isn't equity? That's just, a little leverage or a lot. I don't know. Are you buying companies
Well,
with debt?
so yeah, because we our funds have been small and we've tried to do a lot with a little bit of capital. There has been more debt, but it's actually not usually new debt. What has been happening in our deal? So if you imagine a
Oh,
deal structure, and this I think important. So when you're thinking about a deal structure, what I look at is I say, okay, let's talk about how much debt is there, right? So like how much actual debt has to be handled, how much core liabilities, so like so like your Amazon bill and
yeah.
your
Hmm.
whatever, like these key, you maybe have some like payroll, you know,
Commitments. Hmm.
payroll commitments that have to get made, and then you're looking at the amount of capital that is going to be needed post acquisition, right? So
Yeah.
how much money is this company going to need from you after you buy them? Because like that is a factor in like what you're
Yeah.
willing to pay, and then you get into the actual like equity side of it. But so because of that, what I'll say to someone is, okay, I'll pay you $10 million for your business, but you have $4 million of debt. So 4 million of that purchase price is just me taking your debt. I'm not going to pay it off. I don't have the money to pay it off right away. But I can go to the lender, show them my post restructuring plan and get them to restructure it, get them to give it
Mm.
to sort of hand it over to me. And then I'm like, oh, you have $2 million of vendor contracts. Like, okay, I'm going to call each of those vendors and I'm going to talk to them about coming over and restructuring and like agreeing to give me some time on that,
Yeah.
you
Yeah.
know, and then all of a sudden, you've paid, let's call it $6 million, right, for that company. But you just assumed liability versus actually putting cash out. Now that has its own risk,
Uh, yeah.
but it's it's a surprisingly effective way to build a company, especially if you then the trick is, I will say, you gotta have really good those people that you're carrying over with you. You just have to have really good relationships with them, be really transparent. This is going well, this is not going well. But oftentimes they were looking at a zero. So
Yeah.
your offer is probably better than what they were going to get.
Right.
And they're just want to be like supportive on that. So,
Right.
and that was a really long winded way of saying, yes, there is usually debt on our companies, but it's usually debt we have assumed as part of the purchase price. We're not
Right.
like traditional private equity where we're levering
Okay.
everything up because the companies aren't profitable when we get them. Usually we have to, that's like, we have to like make them profitable afterwards. So they're not eligible for a bunch of leverage right out of the gate.
Now, it must be a little bit, maybe, you're probably talking to founders who've said, "I'm stuck. There's no way out. I'm going to
Yeah.
have to drive this into the wall. I don't find another way." And you're giving them a second chance, if you will, to play this. They probably are, maybe have zeroed this off in their own mind. And then you're saying, "No, but you could be CEO. We'll put you on the cap table. You could make millions here. You could,
Yeah.
revive your dream. It's just, we got to get, it's got to turn into something else on the other side, not this VC funded bet, and get there." They've kind of made up their mind on the ones that are successful that this is a better deal, I guess.
Look, a lot of founders, they put everything into it and they want a second chance. They want an opportunity
Right.
to like do this again. The best, look, there's nothing wrong with someone's motivations being I'd like to, we have one founder who I really like in the portfolio and he's like, I just want to prove those VCs wrong.
Yeah.
I just
Whatever it
want to
takes.
show them. Yeah. They're
Yeah.
like, this really was, a great business. And, that's perfect.
Yeah. So you buy these companies and you buy them well. So I guess and then you help them operate well and grow and produce in order to someday pay back your investment by some type of selling of the business. And that could be to private equity who takes a piece of it and lets you roll some equity. It could be an outright acquisition. You're not buying and holding these companies to take their profits forever like Warren Buffett would, right?
No, no, I do like Warren Buffett, and maybe I should change my strategy,
Well,
but,
I don't know. There's buy and
yeah,
hold
no.
investors
I
out there we've
yeah,
had on the podcast.
I would say agreed. I think when you're in my world, like, as an investor, what I say to myself is, like, "Where do I create value?" And, once you've, like, call it done the bulk of your value creation, just holding it for a really long time, it's not what we're good at, right? It's not what we're
Yeah.
good at. So I
Ah,
describe our model as like we're like fix and flip. We're like fix and flip
okay. Oh, there
for
we go.
technology
Yeah.
companies. Then we say,
Yeah.
you know, that what I was just talking about, this like calling every vendor, renegotiating contracts, this very complicated, it's really just the actual M&A process going from like,
Yeah. Mhm.
is there a deal to like we're integrated? We are excellent, right? My partner Ingrid and I, we're excellent at taking people through that process. And then once they are on a path where they can grow and they're doing well, and maybe we've done one or two add-ins into that company, all of a sudden it's got different problems. We're in the like, how do I grow from 20 million to 50 million? And how do I expand out the team? And what's that management team look like? And do I have opinions on that? Sure. Do I think my opinions are superior to other people's? Absolutely not. It's just not the area that I'm interested in. So yeah, so our goal is to like take an early stage company, like get it restructured, get it back on a growth path, sort of let's say just make sure that we try to make it very stable. So we remove risk, we remove revenue
Yeah.
concentration risk, we remove like sort
Yeah.
of too much debt risk and team risk. And then yeah, we aim to sell it to either a strategic or a private equity firm. So it's been very hard. Like for us, the last call it, 2 years have been difficult because M&A markets have just been shut.
Right.
So there's just
Yeah.
been no one has wanted to do deals really at any material. And we're not looking for giant valuations, but no, it's just been very hard to get anyone to,
Right. Well,
yeah,
this is what practical founders experience, unless they, are 5 million and they're a simple tuck in, quick and easy tuck in for a larger company that goes
yeah,
pretty quickly. The bigger you get, the more complex the deal M&A, game is. But you're like a practical founder that you've got the sustainable, healthy, growing business that is interesting to somebody. You've been in it a while and you want some liquidity. So you're just saying right now, this kind of, let's say, rule of 40 business, some growth, some profitability, some healthy, sustainable there in a good industry. Things have slowed down. It's not the crazy times of 2020 and 2021. But is it stopped? I don't know if you're actively marketing these companies yet.
We are now. We're actually in the midst of doing a transaction. So knock on wood, I'll be back here being
Okay.
like, we've done an
Yeah.
exit, which will be a big, yeah, that'll be a big
Yeah.
move for us. But I would say this year has been the first year that we've started to see like more activity.
Picking up.
It's picking up. So I think, and I do think next year, sort of, if we do get a Fed rate cut, as the election is behind us, like I think there are some things that will just people will start to say, oh, there's a new normal here, and we've got to operate in this new normal because
Mhm.
the business world doesn't work very well when one element, like if you've got your M&A markets are just and you're between M&A and IPO then
Right.
being
There are.
kind of
Yeah.
shut, nothing works very well. So like
Mhm.
everyone, there's not enough liquidity flowing through the market. So I think it will change. We just don't know exactly what the new, let's call it valuation baseline is going to
Right.
be. So, which is why right now, as we buy anything, my point to everyone is valuations still have to be lower because we still have uncertainty about what people will pay for things. So, like,
Right.
if I'm a practical founder today, I'm probably not going to market right now. Like, I'd probably just holding for another
Yeah.
year
Yeah. Build.
because yeah, but I would just keep building. Yeah, or go buy. Right? Actually, if I was
Yeah.
looking at the
Okay.
next
There we
year,
go.
I'd be like, is there someone that I've talked to, like, could I actually tuck something in, spend the next year getting that integration so that when I want to go to market, I've had some growth. And like I was saying, like M&A is a skill, integration is a skill. Private equity firms value that as a skill in their management
Hmm.
teams. So if you're a practical founder and you've actually taken the time to go through a transaction, even if it doesn't go amazingly well, the fact that you've had that experience
Oh, that's
when
great.
you go to market, I actually think can be it's a selling point, differentiation point of your team.
Yeah, the team is experienced in integrating, and it's very complex. It's non-trivial. I spent
Yeah,
years of my life coming and going with transitions, and because that's how exits work. You're part of somebody else's company, or your IPO.
yeah,
That's just a transition, or something like that. So,
yeah.
a decision that practical founders make is they get 5 or 10 million, and they're imagining. It's been a while, and they're looking at liquidity. It could be very interesting for them and their co-founders and the team. At that point, do you use an M&A advisor because it's its own unique game to help you shop a company, or do you do that yourself opportunistically because you're kind of deal people? How do you view that M&A advisor specialist?
For us, it depends. So we do. The answer is yes. Our inclination is to like use an advisor to help us locate buyers. But one thing that we have done, we're doing more now is like I building relationships with various buyers. And even when we acquire a company, they've actually usually been going through a process already, right? So they've probably already hired a bank and their VCs have
Oh,
tried
they
to
tried
sell
to
the
shop. Yeah,
company.
I
They
see.
tried
Right.
to shop it. So what we try to say is can we get contact? Can we talk to those people and say you were
Mm,
interested, but you didn't buy? Why not? What were you looking for? Did you want it
right.
more of this, more of that? Like, was it just a scale issue? Was it a cash burn issue? So I think that's really important. But of course, look, M&A advisors are very important. But I think I would tell people that ultimately getting to a deal involves a good amount of trust. Trust cannot be built in a day. So if you're really saying to yourself, like, I want to be sold next year, I mean, you don't go to everyone, but if you probably got a handful of people in your mind that maybe have expressed interest, like I'd at least be starting to have some of those conversations and saying,
Ah,
"Hey, what's you strategic in my neighborhood? What is your M&A plan for next year? Are you guys in the market? Would it be worth us just having a conversation about our business? I can tell you where we're at and you can like I would just do that because the more time, it's just amazing like that relationship is actually it's just so important. to getting it done. And we think it's just about the numbers and everything, but it's really not. At the end of the day, you got to find, kind of like getting married, right? Is also
Yeah.
another type of marriage. And
Yeah.
so you just want to get married to somebody, you're like, okay, I think this is going to work out. I feel good about this, with marriage that
Right.
I'm going into.
Well, thanks for demystifying that a little bit for practical founders. They think it's somebody else has to do all the work and whatever. But just to even just start with those words that have never been taught to founders, which is
Yeah.
to call a strategic who might acquire you someday, whether they have competitive products or not, and say, "I'm out here. Should we? What what lines in an email or a voicemail would they say? You pantomimed a few of them. I think that would be
Yeah.
useful for
I would,
founders to say, "I'm in this space, you're in this space. Should we be having conversations about someday doing stuff together?" Like, how would you
yeah,
frame those questions? Yeah.
I think there's maybe, let's call it, there's sort of like three scenarios, right? There's large company in your space, let's call it large corporate in your space, where
Yeah.
we're talking there, you find who their corp dev, they've got a corp dev person. And I
Yeah.
would probably on LinkedIn send them a note, and just, I would probably say something like, hey, I'm the founder of this company. This is what we do. We think it is really complementary to you for X reason. And I would love to know, what is your corp dev strategy for like the next year? Like, I'd be curious to know, like, is this an area that you are thinking about buying in? And would it be worth just an intro conversation? Here,
Very nice. Thank you for that.
because
That's
the
very
thing
nice.
is, all those guys, like, everybody needs deal flow.
Yeah.
And so most people will take that call almost 100% of the time. They'll take that call. So there's that call. I would say, what one thing we don't think about is, you're a $10 million company, and like, there's maybe $100 million, maybe private equity backed or maybe venture backed company in your space. And you going straight to their founder and saying, look, like, here's where I'm at. I've built this thing. I'm curious. Are you guys considering M&A as part of the next phase of your growth? And would it be worth us having a conversation so I can be on your radar? Right?
Thank you for that. Oh, it's also very nice. Right.
Yeah.
So,
So, but, and acknowledging, because, and understand that those companies so you're not going to get as good a cash valuation, but you would probably get their stock. So pick the people who their stock, do you
stock is
think, is
worth
going to be
something. Yeah.
worthwhile? And then there's the conversation of actually just, let's call it either direct competitor, call it this direct competitor M&A. So you might be in a place where you're like, we're just not getting anywhere. What if I did go to my, what competitor to say, hey, what
Mhm.
if we just merged? What if we merged and did this together and combined forces and, figure out how to go to market? And that one is really just like, hey, we've been in the same space. I think we're about the same scale. Like, I'm considering my options for exit and what makes sense. And I would love to hear how what you're thinking about on that. And could we just have a conversation? I have a good friend, now a good friend, who also had a fintech platform at exactly the same time that I did. And he and I we're sort of very aligned. And there was this moment in time where we were like, oh, we should merge. Like, we should merge. And honestly, the thing that we laugh about it now, the thing that kept it is, like, we couldn't figure out who was going to be CEO. And we were both too egotistical
Of course.
to like,
Yeah, that's the
to
thing.
like even imagine a scenario where the other one, where you were just not going to be CEO. And he's like, we were such idiots. We should have just merged. We probably would have been successful. And I was like, yes, we were idiots and we should have merged. And I honestly think that would have changed the trajectory of everything. And so, but it just wasn't, I couldn't really get my head around it. But
Yeah.
with the benefit of hindsight, I'm like, oh, yeah, that would have been great. Who cares? I hate being CEO. Turns out I hated being CEO. And now,
Yeah, that's right. You would have, yeah, you would have given
yeah,
up, easily. Yeah, one
yeah,
of the founders in my Practical Founder peer groups, texted me saying, "2 of my competitors called me this week and say, 'Hey, what about a merger? What if you merged us?'"
yeah.
Kind of thing, which I guess is a compliment that you're a little bit further along and we're struggling and maybe, this could be a path. I haven't heard too many of those things. It's surprising when you build a sizable software company, how much conversations you're having with strategics, with competitors that are ongoing that people really don't know about. Your employees don't know about it. And yeah, everybody's just kind of, poking around and seeing, and sometimes things get serious. Really interesting.
Yeah.
What's your expectation for an exit multiple? Are you saying, 5 to 7x for the kind of companies? 5 to 7 times revenues would be, the range. You're not thinking 3x. You've improved these companies. You're not thinking 20x.
Definitely not thinking 20x. 20x would be wonderful, but
Yeah.
that's not. I would say we think about buying like in this environment. If I were buying a tech company, I would not buy for more than 2x enterprise value, which is sort of two x
Yeah.
revenue
Yeah. Mhm.
in combination of debt. No, that I would not necessarily factor in upside stock.
Right.
Right. So they have 2 million in revenue. I would absorb $4 million of liabilities and maybe a little bit of cash. And then I might say, okay, I'll also give you 15% equity.
Yeah.
And so that is kind of how I would think about valuation. So when you buy at call it 1 to 2 times revenue, our playbook is you buy at that, we do get it restructured and
You fix it.
growing. We
Yes.
fix it. So then we take it from say 5 million of revenue that by the time we're exiting, it's 15 million of revenue. And so then even if I also exit at call it a 2x revenue
Oh,
multiple, I've done because I buy like
yes.
I'm a
Right.
big believer, you gotta buy right. You just
Yeah.
gotta buy
Yeah.
right. And you can't overpay because then you're really stuck. It's kind of like taking a valuation that's too high that you can never grow into. Once you've paid too high a price for something, you can never go back.
Yeah. I get it.
So like really being strict with yourself on that part is important. But yeah, that's so overall as a fund, if you three as an investment fund, if you can 3x every fund, people are very
Yeah.
happy. You
Yeah.
3x every fund.
Right.
So that I would say
So it's
on
the
any
same
given
multiple
deal.
of same multiple of revenue. If you 3x the revenues, right? And you find a home for it someday, assuming
Yeah,
there's a home, right?
yeah,
You're in the fund, you're
I'll be
achieving your
great.
fund goals, right? Yeah.
My LPs will be very happy. Yes, they'll
So the upside is in improvement in the multiples as the markets pick up and
correct. But then on
yeah.
the down case, right, I structure so that let's say we're putting a 2 or 3x preference on capital.
Okay.
So even if I
Okay.
buy it at 1 to 2x and maybe I only grow it by 50%, but
Yeah.
then I could still sell it for like 1 to 2x and be like
Yeah.
not be losing money. So in I think when you're in this early stage, you inevitably have to not everything is going to work out. It just isn't. So
Right. But
you have
you
to
have this risk profile that's almost more like a lender, meaning I don't want to lose and I'm going to jump in and manage things. And this is really serious. It's not a little equity and go good luck, kid. You guys are taking it quite seriously, but you have some upside opportunities on top of that.
agreed. Yeah. It's like
Yeah.
we're definitely we're right in the middle. We're sort of
Yeah. Yeah. Yeah.
it's like more risk than debt, it's more risk than traditional private equity because they're not
Yeah.
profitable and things can go wrong. So it's
Um,
more we're like a
mhm.
step up from traditional private equity, but we're definitely a step I would say a big step down from venture. The venture risk profile is like I look at that and I'm like I could not be a venture investor if I tried. Like it's just I no longer have that just like the mentality you have to have, I think, to be in venture. It's just not one that I have anymore. Maybe I had it when I was, 30, starting my first company.
Well, we can imagine founders getting so enthused and thinking big about their opportunity, but VCs, it's a little surprising because they've seen the game, they've seen the odds, they've seen the numbers, they know the game, yet they're still kind of playing this.
I
Uh,
mean,
for
sometimes
many,
it
it's a
works, right?
deception. So yeah, sometimes it works, but
And
they're not really revealing the full scale of it. So you're officially a practical founder and a practical investor, in a
that's right.
very
That's right.
interesting time.
Yeah, you
Yeah.
can start a practical investors podcast. We like five
Yeah,
of
actually,
us.
that's who we're
Yeah,
talking to here is the ones who say there's this interesting swim lane here,
yeah,
because there aren't a lot of practical investors out there and who are doing the work that you're doing to have all those hard conversations up front and see if we can get alignment. And a practical investor and a practical founder who know what the game is and are aligned with incentives and a vision and the pace and the whole
yeah.
thing can be quite magical. But there's just such misalignment out there. It's unfortunate for a lot of founders. Krista, thanks for sharing so much of your experience and knowledge out there. for practical founders out there that are growing their SaaS businesses and, thinking about what private equity and venture does and trying to find examples there and seeing what you're seeing. What advice do you have for practical founders who want to, get to 5 to 10 million in ARR and see what the market will do and win the game their way? What advice do you have for them?
Oh, good question. I think as a practical founder, if you have not taken investor money, you actually have the option to be really creative. You have actually a ton of
Ah,
flexibility in your like capital structure, debt, like just
there you
everything
go.
about your business is you have a lot more freedom than a venture backed founder. And I think that we don't do enough to really leverage that creativity and flexibility that we have because we own our own business and can decide how much equity to give, this stuff. You can give up equity to get something that you want and not necessarily give up voting control, right? You don't have to give
Yeah.
them the same voting shares. Like there's just a lot that you can do. So I think I would say to them, like, just be creative and really be opportunistic, right?
Mm,
We are, I believe, especially right now, there's so much opportunity out there. I'd say that. And then I think just what I'm sure all of your guests say is like, just having now seen so many companies, both venture backed and, companies in our portfolio and talked all these stories. It's all the same story. People that are running out of cash and people that are getting into trouble are the ones that just went for it, but then did not have the discipline to pare back when it wasn't working fast enough. And I think that discipline of just like saying, I took this bet, but I'm just going to cut my losses and sort of protect instead of just sticking with it. That is everything. Having that culture of like, just going back to being practical, right? You have like a moment of like, I'm going to go for it. And then you're like, oh,
Yep.
actually, I'm just going to like, yeah, I think that is critical, right? Finding that it's just balance, right? It's
Yeah.
just one of balance. And I think the last thing I would say though is one thing having taken now companies to market that are in this 10 to 20 million ARR EBITDA positive, the investors that are looking at buying are still very focused on growth. So I think as practical founders, we
Yeah.
can't give up on growth.
Yeah.
That still has to be there, but maybe not crazy growth.
Well, it's kind of your formula as well. It's not just you're going to shell out a company and get all the profits. You actually have to grow this thing for your math to work. And
Yeah.
likewise, they would need that as well. It struck me that the story you said of take the bet, but have a safe place to retract to as the default, it's not very common in VC. The movie story, the big story, the on stage story is we bet it all and it worked. But that's the exception of the exception of the exception there. And it's not very common to have a sustainable, survivable, default alive business where you take small bets to make bigger bets, shoot bullets before cannonballs, as Jim Collins would say in the old days, which is a more practical approach. But it's no, you bet it all, kid. I would go for it if I were you. You just described one of the pillars of the Practical Founders Manifesto, which is survive above all and make great bets.
Yeah. And I think hire slow. I always tried to
Uh,
hire fast. And now, even at stage, I'm so thoughtful about hiring new people. We get so many people, right? Like, I want to be in private equity. I think because what I've learned is once you actually hire someone and they're on your team for any of, I mean, who knows if I'm a good leader or not, but let's assume I'm a good leader, right? Like you have someone on your team and you want to protect them and you want to take care of them, and it makes it very hard to make tough decisions. And so for me, when we're working with
be
our
careful,
founders,
Jeff. Yeah.
when we bring people on, I'm always like, guys, they're like, we could just hire someone internally to do this. And I'm like, you don't understand. Forget the cost of that person, right? Which is high as we bring on employees. I said, but like it's more like the emotional cost of now you have to go through a layoff. Just pay. Yeah, you're bringing in an agency; they're going to charge you double what hiring someone internal is going to
Uh-huh.
cost
Uh-huh.
you. I think it is a we think just because we can do it internally, we should because it's cheaper. Because I don't actually think it's cheaper in the long run. I think you're better off having a contract with someone that can be terminated if it's not working without the emotion in it. And then you keep your team as lean as possible and you protect those people. That is, especially in this environment, like that is what we're telling all of our portfolio companies. Like hiring someone should be the last answer. It's like you first, can you buy it? Can you outsource it? Like, but hiring is the thing you don't want to do because it's so permanent, right? It's so permanent.
Yeah, that's awesome. That's all great advice. Very practical, of course, from a practical investor. Uh, Krista, thanks for sharing your insights and knowledge. I know you're in the middle of the firefight right now and finding companies and investing and building and growing, and you're not on your sixth fund yet with all that experience behind you. I know you'll get there. It's a ton of opportunity. It's a big opportunity, and you have the right attitude for it. So, and you're building for sustainable growth yourself. So it can't not work.
It cannot work. So definitely going to work. No, thank you for having me. I really appreciate it.
Okay. Thanks, Krista. Thanks for watching this week's founder interview on the Practical Founders podcast. Be sure to hit like and then subscribe to my Practical Founders YouTube channel to keep up with my weekly videos for serious software founders who are building valuable companies without big funding. Check out my blog and information about my Practical Founders CEO peer groups at practicalfounders.com. And follow me on LinkedIn to keep the conversation going. See you next week.